In today's video, I wanted to talk about one fund in particular that I think is pretty fascinating, and it's also caused a lot of debate among dividend investors from what I've read on various websites. In some ways, it looks like a pretty terrifying investment. As you can see by the overall performance of its share price over the years, it's gone down pretty significantly. But what's fascinating is when we run the numbers and calculate the total return from this fund over the past year and the past several years, it's actually been providing some pretty impressive returns overall that even during certain market conditions has outperformed the S&P 500. This is a fund that I've discussed one time on this channel before about 8 months ago, and today what I wanted to do was do a little check-in and see how it's been performing given the recent news about its dividend increase, especially since I continue to see a lot of people in my video comments talk about this fund. The stock I'm referring to is the Cornerstone Strategic Value Fund, ticker symbol CLM. This is a closed-end mutual fund launched and managed by Cornerstone Advisors. The fund invests in public equity markets across the globe and seeks to invest in stocks of companies operating across diversified sectors. The fund primarily invests in value and growth stocks of companies and also invests through other closed-end investment companies and ETFs. The fund was launched all the way back in 1987, which makes it one of the more older CEFs that I've come across. I first discussed this fund in a video back in April of 2021, and at the time it was trading for $13.13 a share, and it was issuing dividends at a rate of about 16 cents per share per month. As of the making of this video, it's now trading at about $14.04 a share, which is an increase of almost 7%, and they just announced a couple weeks ago that the fund is now increasing the monthly dividend to 18 cents a share, which gives CLM a current dividend yield of 15.34% according to Yahoo Finance. As I mentioned earlier, CLM looks like a pretty terrifying investment if we expand the long-term share price performance of this fund. As you can see, this fund was once trading at $260 per share all the way back in 1999, right before the dot-com bubble burst, and eventually hit an all-time low during the 2020 pandemic plunge at about $6.82. Since March of 2020, this stock has more than doubled in terms of its share price. If we take a look at the dividend history for this fund, we can see a constant downgrade in terms of how much this fund pays in dividends every month. So while everything appears to be going horrendous in terms of its share price performance and dividend distributions over the long term, in my original video I keep seeing comments as well as people on Yahoo Finance and other websites commenting that they've experienced some pretty stellar gains from this fund. And in fact, when we use a total return calculator to see the overall returns of this fund when we choose to reinvest dividends, the results are pretty impressive in terms of the last few years. Over the last year, a $10,000 investment into CLM would have left you with an impressive 43% return on your investment. Your original $10,000 would now be worth $14,300 in just 1 year, which is pretty impressive. If we compare that with the S&P 500, CLM has outperformed the index fund SPY by about an additional 12%. If we look at the 3-year performance, we can see that $10K investment into CLM would have more than doubled your investment, which you would now have $20,679.71 and still perform better than the S&P 500. Finally, let's take a look at the 5-year performance. You can see that CLM slightly outperformed the S&P 500, which you would now have $24,193.08. From these graphs, you probably picked up on the fact that the longer we go back in the past, the worse things get for CLM in terms of the overall better performer when compared to the S&P 500. What's interesting though is the fact that despite the downward movement of its share price, even if you would have invested in CLM 20 years ago and reinvested those dividends, you would have not lost money. This is because CLM pays such massive dividends that they actually make up significantly for the declining share price. It's definitely not a great return. As you can see, the S&P 500 delivered much better results, but even if you bought in when it was over $97 a share, with reinvested dividends you would not have lost money. But judging by what we've looked at already, it's obvious that CLM is a pretty bad choice in terms of a long-term investment if you're only looking for dividend income. Despite that though, we've already seen that it is possible to attain good investment returns from CLM under certain conditions. But how exactly can investors experience the most financial returns from this fund, and how on earth is this fund able to generate such extremely high dividend yields to investors in the first place? Let's try taking a deeper look to see how we can make some good money from CLM. As I mentioned earlier, CLM is a closed-end fund, or a CEF. This is an investment type that in some ways is similar to an ETF, but there are some distinct differences between the two. Both investment types hold a diversified collection of different stocks and funds, and they're both traded on exchanges. But what makes CEFs stand out apart from ETFs and mutual funds is that they often use leverage as a way in increasing the amount of dividends that they issue to shareholders. Because of this, CEFs are generally considered riskier investments than ETFs, but it all depends on what they hold. There's also a fixed amount of shares issued by a CEF, and they're almost all actively managed compared to ETFs, which are for the most part passively managed. A downside to actively managed funds is that they often carry higher expense ratios than most mutual funds and ETFs. Some CEFs will even charge expense ratios of over 2%, so it's usually a good idea to be mindful of the more expensive ones, as I've personally never encountered a closed-end fund with an expense ratio of over 2% that came with such great results that it actually justified the high fees. But back to CLM specifically, if we look at what this fund holds, we can see that its top holdings include a lot of big name companies, including Amazon, Apple, Microsoft, and even Berkshire Hathaway, with this fund being pretty well diversified across different sectors, including technology, healthcare, financials, and consumer cyclicals, among many others. In total, this fund holds about 164 holdings as of November 30th of this year, according to Seeking Alpha's website. Let's take a closer look at the dividend distribution history of this fund, which is pretty crazy. Over the years, this fund has continued to decrease their monthly dividend distributions on a regular basis. All the way back in 2007, CLM was paying $1.49 a share per month, whereas now it only pays 18 cents a month. According to a press release, this fund also plans to keep their distributions at 18 cents per share until the end of the year. And after that, who knows if they'll grow it, cut it, or if they'll be able to even maintain it. It's also worth mentioning that there's a very similar fund out there called the Cornerstone Total Return Fund, which is ticker symbol CRF. This fund is very similar to CLM in almost every way. The dividend distribution amount is very similar, and so is the long-term performance of this fund in terms of its share price. The only difference I could really find is that the holdings are only slightly different. I'm not too sure why this fund even exists since it's almost mirroring CLM in almost every way, but both funds have almost identical returns as of last year, in the last 5 years, and decade too. But oh well, I guess. So what can we take away from CLM, and I guess CRF too? First off, if you decide to invest in either of these two funds, then reinvesting all of your dividends is absolutely crucial. This obviously isn't the type of holding where you can just turn off the drip and just live off the dividends. I know that we saw earlier that even if you held this fund for decades and reinvested all of those dividends, you'd still be looking at a profit, but there's just so many better options out there if your game plan is to never live off the dividends. But again, the good news is unless you enter at a really horrific time, like while the market is plunging, it's actually pretty difficult to lose money with CLM over the years as long as you're reinvesting those dividends. Secondly, judging by past performance, this fund tends to do really well during bull markets. As we just saw earlier, this fund's been performing pretty well post-COVID. It's been able to beat the S&P 500, and it was still beating the S&P 500 before COVID. It appears that the best time to get into this fund is after any kind of correction in the stock market. Given how poorly this fund has done during bear markets, if you do decide to buy into CLM or CRF, then this is one of those funds that I'd recommend getting rid of if it looks like the stock market is going to suffer some major losses. Unless you're willing to wait for this fund to correct, which who knows how long that'll take. I'm not currently a shareholder of CLM or CRF as of the making of this video because personally, while I know you can outperform the S&P 500 during bull markets with this fund, I'm just not interested in trying to time the market. But judging by the comments I read, I do see that some people who have really enjoyed the gains they've received from this fund since they got in at a great time. If you do decide to become a shareholder, my advice would be to buy dips, always reinvest dividends, and sell it if it looks like the market is going to drop significantly. But I'd be curious to know what you guys think about CLM and CRF. Are you currently a shareholder in either of these funds? And if you are, what's your reasoning for opening a position in either of these two? If you're avoiding it, feel free to share why as well, although I can probably guess what the reasons are. These two funds are definitely risky, so be sure to perform your own due diligence and research before coming to a decision to buy shares if you choose to. Alright everyone, that's going to wrap up today's video. Thank you all so much for watching, I really do appreciate it. If this video benefited you in any sort of way, please click the like button below and click subscribe if you want to see more dividend investing strategy videos. It would just let me know that there's a sizable enough audience out there who wants this kind of content, and I'll continue to provide you all with that content. Alright everyone, thanks again for watching and I'll catch you next time. Take care.